Thank you for joining me today for a Q1 Global Flex update. First Pacific Advisors appreciates its long-tenured partnership with Nedgroup. To begin, we always start with the performance slide. The Global Flex Fund gained 5.5% in Q1 2024 and 18.7% for the trailing 12 months, ahead of the fund's performance indicator, but behind the MSCI World Index. The fund is ahead of its performance indicator for all of the more extended periods, that is 1 year and more. The stock market has had very narrow breadth, with a small number of companies driving its return. Just 4 stocks comprise 45% of the S&P 500's return, while these same 4 stocks drove 34% of the MSCI ACWI's return. NVIDIA alone made up almost a quarter of the S&P 500's return in Q1. We operate with a long-held belief that price matters. Global Flex's portfolio trades at a lower valuation than the stock market average, both on price to earnings and a price to book basis. Our companies are also growing businesses, and while it remains to be seen whether their growth will be better or worse than many of the companies that are driving the indices today, we believe that their lower valuation should allow the portfolio to perform well over time. It's always good to invert a thesis. We want to avoid the hubris that we cannot be wrong. Of course we can, and we're often wrong. If bullish on a company, we try to build a bear case. And if we're bearish, then it's the bull case we make. And doing that helps limit, our mistakes, hopefully, or when we do realize we're wrong, get out of a situation sooner rather than later. Conviction in our position is based on considering all angles, and our opinions will evolve as facts and circumstances change. Take NVIDIA, for example. The company is leading the AI chip war, but will its $2.2 trillion market value be justified? It might. However, it's interesting that when it reported earnings last month, its market cap increased by $273 billion, more than the $245 billion U.S. public market value for all gold mining stocks. That may prove justified, but maybe not. We don't have an investment conclusion from this seeming disconnect, but it's what we like to think about as we form what are often variant views. In the trailing 12 months, Global Flex's top 5 performers contributed 8.2% to its return, while its bottom 5 detracted just 1.1%. In the last year, we have discussed most of the contributors and detractors in commentaries and calls. GD Peets is one position, though, that we have yet to chat about. It's a small position and the detractor from return in the trailing 12 months. The company is currently navigating many issues, including the effects of the war on its Russian business, the lingering impact of the pandemic that curtailed out-of-home demand, and having to fight massive inflation and coffee prices. Management has not navigated these challenges as well as we would have hoped. GAB, the majority shareholder, sees it similarly, which explains their ousting of the former CEO. While the jury is still out, and we don't yet have conviction to increase the position further, the stock does appear relatively inexpensive at just 12.5 times this year's estimated earnings, but it remains a work in progress. Global Flexible's net exposure, equity and bonds, is unchanged year over year at around 64%. However, that's not to say there hasn't been activity during that time. During the quarter, we exited 2 positions in their entirety and initiated 2 new positions, 1 convertible bond and 1 Japanese equity. The fund's asset allocation composition has remained mostly the same since last year. So there's nothing really new to address here. Cash remains the most significant allocation at 35%, but the most prominent risk asset exposure continues to be the broad sector of communication services at 14.4%. Just under 40% of Global Flex's equity exposure is to companies based outside the United States. As we often point out, where a company is based is of secondary importance to the quality of a business and the price at which it trades. More relevantly, if we examine the revenue composition of our portfolio companies, a bit more than half is derived from outside the United States. We are fortunate to be able to invest broadly, as other parts of the globe trade less expensively than the United States. I wanted to close with what's known as the Buffett indicator. Warren Buffett has often opined that when the aggregate value of the stock market, the US in this case, is high, future returns are likely to be weaker. The blue line, as measured by the left y-axis, is the Buffett indicator, which shows the total value of all publicly traded stocks in the US relative to US GDP. When its value has been lower, the stock market's 2-year forward return, which is shown on the right axis, and the stock market's 2-year forward return has been strong, which is the green shaded area shown here. Now, when its aggregate value is low, the 2-year forward return is weak. Note the red shaded area. Today, looking at the far right, the aggregate value is near its highest, which helps explain why it has been more challenging for us to put money to work and helps explain our substantial cash position. That's the end of our prepared remarks. There are a few questions that have been offered up by Nedgroup and investors in the fund in advance. I'm going to let those come up on the screen and address those. First question, given the portfolio manager's different backgrounds, what does contrarian value mean to you and how you think about equity investing? Brian Selmo, Mark Landecker, and I, as portfolio managers of this fund, are like-minded, but obviously, as the question points out, different people. But the one thing we have in common is we like to buy when others are selling and sell when others are buying. We like to, arbitrage fear and greed in the market, take advantage of the opportunities presented. So we are always more excited when shopping in stores where they're offering merchandise at a discount. And that's, what we have in common. That's what contrarian means to us, is buying what others don't want to own. And similarly, selling at a point in time when everybody else is really excited, taking advantage of the so-called animal spirits. Next question. What is the thought process behind sizing positions? There's a few considerations when we think about sizing a position. First is, what is the quality of the business? Second is, what is the value of that business? What is its price in the market? Is it inexpensive versus where we think it should be trading today, or we think it might be trading in the future? What's the growth rate in that business? And how that earnings might increase in the next few years, which might make it seem cheaper still. And then lastly, conviction and outcome. So it's quality, price, and conviction. And the combination of those three will really come together, and having a favorable view of all three will make for larger positions. Another question, are there any areas in which the opportunity set has improved? As I pointed out on the previous slide, the Buffett indicator slide, which showed valuations and how we are at the upper bounds, the stock market's kind of lifted all boats of late, which has made it fairly difficult to find any one area of significant opportunity, which, again, as I said, helps explain why we have as much cash in our portfolio as we do. You have two of the top performing stocks in the first quarter, Meta and Alphabet. Do you still believe that these offer attractive prospective returns and a sufficient margin of safety? Really a fair question, because both stocks have been excellent performers, but they certainly don't offer the same risk reward when we first purchased them. We bought Alphabet more than a decade ago when investors were quite fearful of what was going to happen to their ad-based business when the economy was slowing down. We bought we bought Meta during the Cambridge Analytica scandal a number of years ago as well. And that similarly, created an opportunity when where people were quite fearful, and the stock was relatively cheap. Neither are as cheap today, but we believe both are relatively attractive to the market when considering their current valuation and what their growth should be prospectively. And in the case of Meta, with what's happening at the government level in the U.S. in terms of what may or may not happen with TikTok, are certain circumstances where government involvement, regulation, or even possibly a change of ownership of that company could benefit Meta. And so that's something that's in its future. But look, none of these businesses that we own have insurmountable uh, barriers to entry. Every company, can potentially be impaired, and we're always mindful of that. So we always take, a an honest view of what these companies are doing and consider what's happening in the competitive landscape. There's one last question. How do you evaluate the quality, of a business? Speaking back to the point I was making about when the question arose about what is our thought process behind sizing positions, I said quality, price, and conviction. So addressing the quality, side of that, for us, a quality business is a business that has a defensible moat. It can really withstand, competitive threats. That business has very good returns on capital on an unlevered basis. The business isn't over levered. The business is growing. And I don't just mean the revenue line. A lot of companies can grow when they just start taking price and get greedy. We want to see unit volume growing in this business and the ability to get price as well to maintain margin, particularly in this inflationary environment we operate in. That quality business is a business that will have free cash flow and, very importantly, an appropriate use of that free cash flow. I think that's a fair summary of how we evaluate the quality of a business. That concludes all the questions. Thank you again for your time.